All right, let's get right into it. We're about to unpack one of the most clever and, honestly, one of the most controversial products in all of modern finance. It's called Tawarruq, and it really gets to the heart of a huge debate about the very soul of Islamic banking. But before we get to that, here is the central puzzle we've got to solve. You have this massive global Islamic finance industry, and it's all built on one core rule. You cannot charge interest. So how on earth do you give someone a simple cash loan when they need one? That question, well, that's what led to Tawarruq. So here's our game plan. We'll start with that fundamental rule against interest, then look at the puzzle it creates for banks today. After that, we'll walk step by step through the Tawarruq solution, and then we get to the juicy part, the big debate. Is it a real transaction or just a legal workaround? We'll explore the spirit of the law and wrap up with a big question about integrity. Okay, so let's start at the very beginning with the absolute cornerstone of this entire financial world. I mean, we are talking about an industry that's managing over $2 trillion in assets. It's huge. And every single bit of it is supposed to be guided by this one profound principle. And that principle is the prohibition of riba. You probably know it as interest. But it's so much more than a technical rule. It's a really deep moral command. It's all about preventing the exploitation of people in debt and ensuring that finance is a tool for fairness, not just for making money from money itself. But that powerful moral foundation, it creates a massive practical challenge in our modern world. Think about it. What happens when a small business needs a quick cash infusion to pay its employees? Or a family has an unexpected emergency? In a conventional bank, it's easy. You get a loan, you pay interest. But you can't do that here. And that is the exact puzzle that Islamic financial engineers have been trying to solve for decades. And that brings us to their most popular and definitely their most debated answer, the Tawarruq transaction. Okay, hang with me for a second because it seems complicated, but it's not. Let's walk through it. Step 1, you walk into the bank and say, I need $10,000. Easy. Step 2, the bank, behind the scenes, buys $10,000 worth of a real physical commodity, maybe some metal on the London Metal Exchange. Step 3, the bank then immediately sells that same metal to you, but on credit. And they sell it to you for, let's say, $12,000 that you'll pay back over the year. Now, for a split second, you own that metal. Step 4, you immediately authorize the bank to act as your agent and sell that metal for you. Step 5, the bank sells it for $10,000 in cash, and that cash goes straight into your bank account. You walk out with the money you needed, and now you owe the bank $12,000. So, on paper, everything checks out. There was a series of real sales, a commodity was bought and sold. But what really just happened here? This is where things get very, very heated. Yeah, prominent critics like the scholar Mahmoud al-Gamal, they don't pull any punches. They call these things sale-based ruses. And why? Because they argue that all these complicated steps exist for just one purpose, to create the exact same financial result as a regular old interest-based loan. In Islamic law, there's actually a specific word for this concept. It's hila. It basically means a legal loophole, a way to use the technical rules of the law to get around what the law was actually trying to accomplish. And critics say Tawarruq is a perfect example of hila. And this slide, wow, this slide really lays it bare. Let's just look at it. What's the client's goal in both cases? Get cash. What's the final economic outcome? Get cash now, pay back more later. The bank's risk? Pretty much just the risk the client won't pay them back. So, minimal. The only real difference is what you call the profit. One calls it interest, the other calls it a markup. So the critics ask, if it walks like a duck and quacks like a duck, is it really a different animal? And this takes us way beyond the mechanics and deep into the philosophical heart of the whole thing. It really is that classic battle, the letter of the law versus the spirit of the law. You see, Islamic law isn't just a list of do's and don'ts. It has these higher goals, what's known as the maqasid ash-sharia. The whole point is to build a financial system that's about social justice, about shared risk, about partnership, not just about debt. So the big question is, does a transaction that's designed to give a bank a guaranteed, basically risk-free profit while the customer takes on all the debt, does that truly live up to those higher goals? And some critics, well, they go even further. They call these practices camouflage for interest. They see it as a betrayal of the whole promise of Islamic finance, a failure to provide a real ethical alternative. So this entire debate really forces the industry to take a hard look in the mirror and ask some tough questions about what it wants to be. At the end of the day, this is the fundamental choice. Is the goal just to create products that can check a bunch of legal boxes and get a sign-off? Or is the goal to actually innovate and create products that truly embody the moral principles that the ban on interest was meant to protect from the start? And that's the question I want to leave you with, because it's bigger than just one financial product. In any system that calls itself ethical, what really matters more? Is it the fine print in the contract, making sure you followed the letter of the law? Or is it the real-world outcome, the spirit of the transaction itself? That's the billion-dollar question at the heart of the Tawarruq controversy.